Hidden deep inside U.S. banking law is a power most Americans have never heard of and were never warned about. It is called bail-in authority, and it allows regulators, during a banking crisis, to legally take money out of your bank account and convert it into shares of stock in a failing bank. Not a loan, not a temporary freeze, not FDIC reimbursement. Stock in a bank that is already collapsing. This is not speculation or conspiracy. It is written into federal law, and it has already been used in a Western democracy. Today, the same conditions that triggered bail-ins before are quietly forming again, this time inside the United States. Most people do not realize this, but when you deposit money into a bank, it is no longer legally your money. It becomes a liability of the bank, essentially an unsecured loan that the bank owes you. Under current law, unsecured creditors can be forced to absorb losses when a bank fails. That includes depositors. For most of modern history, governments handled bank failures in one of two ways. Either the bank collapsed and depositors lost money, triggering panic and economic damage, or the government stepped in with taxpayer bailouts. After the 2008 crisis, when hundreds of billions of dollars were used to rescue Wall Street while ordinary people suffered, public outrage made bailouts politically impossible. Regulators needed a new solution, a way to save banks without using taxpayer money. That solution was the bail-in. Instead of taxpayers absorbing losses, depositors would. In a bail-in, regulators seize a failing bank and restructure it. Shareholders are wiped out first, then bondholders, then uninsured depositors. Deposits above insured limits are converted into equity, meaning bank stock. On paper, you still own value. In reality, that stock is nearly worthless because the bank is already failing. Once a bail-in begins, accounts are frozen, trading is halted, you cannot sell, you cannot move your money. You are trapped while your savings collapse in real time. This has already happened. In 2013, Cyprus experienced a banking crisis after heavy losses tied to Greek debt. Rather than using taxpayer money, the government imposed the first modern large-scale bail-in. Banks were closed without warning. ATMs were shut down. Transfers were blocked. When banks reopened weeks later, depositors with balances above 100,000 euros discovered nearly half their money had been converted into bank stock. That stock quickly collapsed. Real losses were closer to 80%. Small businesses failed overnight. Retirees lost their life savings. Escrow accounts were wiped out. Every part of it was legal because the legal framework had already been established. What most Americans do not realize is that the same legal authority exists in the United States. It is embedded in the Dodd-Frank Act, passed after the 2008 crisis. Title II grants the FDIC what is called orderly liquidation authority, which allows regulators to take control of failing financial institutions and convert debt obligations into equity. Bank deposits are legally classified as debt obligations. That means your deposits can be converted into stock. This law has been active for more than a decade. It was never hidden, just never explained in plain language. Regulators have even published detailed plans explaining how bail-ins would work. In 2012, the FDIC and the Bank of England released a joint framework describing how losses would be imposed on shareholders, bondholders, and uninsured depositors using a method called single point of entry. The question is not whether bail-ins are legal. The question is when they will be used. The answer points directly to commercial real estate. Hundreds of regional banks in the United States are dangerously exposed to commercial real estate loans, including office buildings, retail centers, hotels, and apartment complexes. Many of these loans were issued between 2019 and 2021 when property values were inflated and interest rates were near zero. Today, office vacancy rates exceed 30%. Property values have dropped 40 to 50%. Refinancing is often impossible. Buildings worth $200 million just a few years ago may now be worth $100 million while still carrying $150 million in debt. That gap becomes a direct loss for the bank. Analysts estimate between $400 and $600 billion in potential commercial real estate losses. More than 180 regional banks have exposure exceeding 3 times their capital buffers, meaning even modest defaults could wipe them out. The FDIC insurance fund holds roughly $128 billion, while total U.S. bank deposits exceed $18 trillion. That means the FDIC can cover less than 1% of total deposits if multiple banks fail at the same time. The fund will be overwhelmed. When that happens, uninsured deposits become the shock absorber. This is not just a problem for the wealthy. Uninsured deposits belong to small business owners holding payroll cash, retirees temporarily holding home sale proceeds, trust and escrow accounts, professionals managing client funds, and real estate transactions awaiting settlement. In total, nearly $9 trillion in U.S. deposits are uninsured. Here is how this unfolds. A regional bank announces massive loan losses. Its stock collapses, depositors panic, withdrawals accelerate, liquidity dries up. The Federal Reserve refuses emergency lending to an insolvent institution on a Friday evening. Regulators seize the bank. Branches close. Online access disappears. Monday morning, insured depositors regain access while uninsured balances are converted into equity. Weeks later, the bank is sold at a discount. A $300,000 balance becomes $60,000 in liquidation value. Scale this across dozens of banks. In 2026 and 2027, roughly $1.5 trillion in commercial real estate loans mature. Many will default. Failures will cluster. Once the first bail-in occurs, confidence collapses, withdrawals spread, and the crisis accelerates. The people most affected will be in the middle. Small business owners, retirees, professionals, and ordinary savers who trusted the banking system. The ultra-wealthy and large corporations largely avoid this risk because they do not keep cash in traditional bank deposits. Protection requires action. Know your bank's commercial real estate exposure. Keep deposits within FDIC limits across ownership categories. Move excess cash out of banks into treasury bills held directly. Structure trust and escrow accounts properly. Most importantly, do not wait for headlines. By the time bank failures dominate the news, exits are already closed. The legal framework exists. The financial pressure is building. The plan is written. This is not fear. It is awareness. You have been warned. What you do next determines whether you are protected or whether you become part of the next headline.